Hey guys, thanks for bearing with our technical difficulties. Welcome to today's webinar hosted by me, Jonathan Donald, and Invert Ventures. And today we're going to be talking about getting small businesses the support they need right now using a tool called the Zero APR Balance Transfer Credit Card. And the purpose of today is really to help small businesses access a tool for cash flow to keep them operating in really uncertain and cash crunch times. A little bit about me. I'm a change management consultant. I have helped a number of small enterprises and individuals restructure the way they do cash and cash payments on the side of my normal business. Scott, Donna, is that you? And basically what we're going to be going today and discussing is how to use these tools to get zero APR balances from anywhere from 6 to 12 to 18 months. And for me as a small business owner, this has really helped defer payments into the future. And I've used this with clients to totally reinvent their financial system, getting them better rewards on the things they buy. So let's jump in. So, quick agenda for today. We'll go through our mission and purpose. We'll discuss balance transfers, what they are, how to use them, and a few tips and tricks to make this a really easy behavior and system for you to use in your daily life. And then we'll go through a few additional resources and preferred links. So, as I mentioned in the beginning, the purpose of this webinar is to help give small businesses cash right now. Cash flow is king, especially in turbulent times. And right now, it makes the difference between surviving this downturn period and participating in the eventual recovery. So, when I say cash now, what are we really talking about? What we're talking about is increasing the time you or your business has to pay for the things it buys, while ensuring that for everything you buy, you're getting the best cash back rewards possible. That's the purpose here. Now, we're going to go through what is the 4-quadrant approach. So, mindset, behavior, culture, and systems, to make sure whatever we teach today is really used in a holistic way. So in the mindset quadrant today, I want you to think about something called the standard rate. So whenever you buy something, whenever you're next paying business rent, or buying supplies, or invoicing a client, the standard rate on everything you buy, from training materials to rent to food, is 2% cash back and 25-day payment terms. 2% cash back and 25-day payment terms. That is the standard that everything compares to. And it's very easy to use, and it's achieved by using credit cards and a digital check service. And we'll explain how to do that later on today. But that is the main point here. Now, by deferring payments into the future, the whole point is to keep cash in your business right now. If you have a $10,000 bill, by using a zero APR credit card, we can defer that payment out 6, 12, sometimes even 21 months. And that helps you as a small business stay better capitalized, and right now make the difference between staying open and not participating in the recovery. So let's go a little further. See how this looks. Can you see my screen? Great. So what are balance transfers and how can they help? Balance transfers are a credit card offer, and they come in two major forms. The first is when you open a new card. Many of these are called specifically balance transfer cards. Ooh, look, there's a scratch. You know what? It's coronavirus time, so always have a cloth or some kind of tool to scratch your nose so you're not using your hand. These little things always come up, but they make a big difference when we're looking at behavior. So balance transfer cards, they come as either a separate card offering, or oftentimes the credit cards you have a additional offer for a balance transfer. And right now, many cards are offering 0% APR financing. So what does this let you do? Well, a balance transfer allows you to pay off a set amount based on your credit on a specific card over a period of time with 0% interest on that balance, as long as you meet a few conditions. So when we say 0% APR, what does that actually mean? Well, it means there's a 0% annual percentage on your promotional period. And this is going to be important because that promotional period is the length of your balance transfer offer. So if it's a 12-month balance transfer, that's 12 months, 0% interest. 18 months, 18 months, 0% APR. This means you have to pay off that balance to avoid the interest within that period. So what does a balance transfer mean for your business? Well, instead of paying a full bill right now, you can conserve cash. And for business owners, any balance transfer fee or financing fee you pay as a result of using these offers, that's all tax deductible. So let's go through an example that'll really explain what's going on here and make it practical. So let's say that my business, Invert Ventures, opens up a new balance transfer card. And we open up a balance transfer card with Citibank for $10,000 of credit. I've just done this great training course. It was a needed expense for me to be able to offer the services I want for my clients. And that had a cost of $8,000. Excuse me, that's an $8,000 credit, and I have a $10,000 training course. That $8,000 credit on my balance transfer credit card, that's 18 months with 0% APR and a 3% balance transfer fee. Balance transfer fees are one of the reasons why credit card companies offers balance transfers. They're designed to help a bank take clients away from their competitors by transferring a balance from one issuer, usually a bank, to another. There is a fee for that service, but if you're a business, those fees are tax deductible to you. So the upfront fee on my $8,000 that I want to transfer is $240. We're going to use the invert rule. And the invert rule is a quick and easy rule to make sure that you never get charged additional interest on your balance transfer. If you don't pay off your balance transfer by the end of the promotional period, certain credit cards will offer what they call deferred interest. And that means that the interest that you would have accrued naturally is applied retroactively at the end of the balance. We want to avoid that because that can be huge fees. And that's how these credit card companies make a ton of money on balance transfers. But by using the invert rule, it's a quick system to ensure this cannot happen to you. So here's how it works. You take the balance that you want to transfer, in this case $8,000, and you take the length of the balance transfer offer, 18, minus 1 month to make sure you've paid it off by then. So in this case, it's $8,000 divided by 17 months. So I will get $475.82 a month equal payments over 17 months rather than paying $8,000 up front. I'll still have to pay the $2,000 of cash to pay off that remaining balance, but because it's a balance transfer, I've effectively used one credit card to pay off another. There was no cash transfer of that $8,000. So I've only lost $2,000 in cash, and I've kept that $8,000 in my business to be used for necessities in these troubling times. That's how balance transfers can help you recapitalize your small business and extend out the payments for the things you need to buy. So, how do balance transfers fit into your cash flow strategy? Well, right now, we're just going to touch briefly on a cash flow strategy for small business. The scope of this webinar is really focused on the tool of balance transfers, but I wanted to give you a framework of where this fits. So when businesses are cash crunch, the first thing is to reduce non-essential spending. And you can see this in the marketplace right now, particularly airlines. They're furloughing workers, they're not doing capital expenses. But what does this mean for small businesses? Small businesses that have expenses that are not absolutely urgent, this is where they're pushing them back and saying, do we really want to invest in this right now? The next step a lot of businesses look at is defer payments with their providers. So we have a great example about what happened yesterday out in California. The government of California negotiated with several major banks to offer mortgage and rent deferrals for 90 days. That's an example of negotiating directly with the merchant and vendors, and they're offering those payment terms. Now, many vendors for real estate, for corporate suppliers, are offering these small business supports because they want to keep their customers in business. A great strategy and behavior here is to call these suppliers, merchants of yours directly and ask what kind of deferment programs they have. I've seen a lot of success by just picking up the phone and saying, do you have a deferred payment option in place? Now, once those two things are maxed out and you've looked at those, the next place to usually go is balance transfers. And so this is we're really financing essential spending. We're moving cash outlays into the future to conserve cash right now. And again, you need to have cash on hand in these uncertain times. This is a great way to do that. And finally, if balance transfers are not available, we'll look at the direct payment model. And what I suggest is we always use, when possible, a credit card to achieve 25-day payment terms. We also use a service called Plastic, which is my favorite, which allows digital checks to be sent via credit card. And if you prefer, they can also mail a check. But the important thing here is that the payment comes via credit card, so you still get your 25 days in addition to what the vendor would have offered you normally. All of those fees that you would pay, both the credit card processing and the check fee, for a business are tax deductible. So it makes sense to offer those better payment terms for your business and deduct them from your federal and state taxes. So, how do they work? Well, we've already discussed how they allow you to pay off a balance for a set period. They come in two major formats: as a separate card or an offer on an existing card. And the ranges we see are 6 months, 12 months, 18 months, and for a very few specialty cards we'll talk about later,